Good evening, and thank you for joining this live Tenant Farmers Association webinar. What can I do to prepare my farming business for the planned changes on inheritance tax? Before we get started, I have some housekeeping to talk through first. I'm Robert Martin, and I'm the National Chair of the Tenant Farm Association, and this event is kindly sponsored by Roy Thorne Solicitors. For those who don't know, Roy Thorne's is a national law firm steeped in agriculture. They have 90 years experience advising landowners and tenants alike. Their lawyers are active in farm tenancy policy groups. They get the bigger picture. So whether it's a succession application under the Agricultural Holdings Act, a new farm, a business tenancy, a dispute with your landlord, a share farming agreement, or a collaborative natural capital agreement, Roy Thorne's is there to advise and assist. If you miss any of tonight's webinar and you want to re-watch it at a later date, it will be recorded, and once edited will be available on the TFA YouTube channel. To find our channel, go onto YouTube and search at Tenant Farmers. The TFA video library features all the past virtual events, knowledge share, teachings, and news snippets. We encourage you to visit and subscribe to the channel so that you'll be notified when we upload new content. And if you search for Tenant Farmers, you will find us there. Moving on to this evening's event. Tonight we are pleased to welcome Andrew Vickery, Head of Rural at Old Mill Accountants and Financial Planners. Andrew heads up the rural team at Old Mill and is a TFA Recommended Professional for our southwest area. Coming from a Somerset farming family, Andrew achieved a first-class honours degree in agriculture from the University of Reading with a particular focus on tax planning matters. Andrew has represented the TFA on DEFRA and HMRC panels and regularly contributes to the farming press and speaking engagements. Following a short presentation from Andrew, we'll be joined by the TFA's Chief Executive, George Dunn, for a live 30-minute question and answer session. This is your opportunity to engage with our expert speakers to clarify the related topics for this evening. So I'll remind you all again that if we've got any questions in your own mind that come up while either Andrew or George are speaking, if you can put them into the question section at the bottom of the Zoom page tonight, then I will pick them up as we go along. We have some questions have come in advance of tonight because we've got one guy on a combine and he wants to know the answer to something very important. So we'll look forward to get the answer to that one there. So I think it's time for us to start this evening's webinar, and I will do that by inviting Andrew to the floor. I'll hand over to you now, Andrew. Thank you.
Robert, thank you very much. You kindly introduced me. It's nice to be speaking to everyone from a very hot and sunny Somerset. As Robert said, I am head of rural Old Mill. We're a mixed accountancy practice, but with a very significant rural team. We're about 100 strong in our rural department. And I think it's fair to say on the, whenever it was 30th of October 2024, our world rather got turned upside down because we've got a very, very significant number of farming clients who were unsurprisingly quite interested in the announcements that came out of the budget from Rachel Reeves. So we've spent whatever it is now 8 months unpicking these changes. Obviously there's still some detail left to be rolled out, but we've had a great deal of work with clients working through what it means for them, and in many cases sort of bringing forward by quite a few years their succession and tax planning they would otherwise have done. One of the challenges, speaking to many of you at the moment, is everyone will probably be in a different place with this. So some will have had extensive conversations with their accountants and solicitors and will be a long way ahead in terms of their own planning. Others will not really have made a start yet, and that's absolutely fine because there are different sort of needs for people to be further ahead or further behind, often driven by age or their circumstances. So we'll try and sort of cover things broadly, but obviously questions can be more specific as and when we get to that point. So Julia, if we can go to the first slide, please. So really just a few of the basics. these acronyms, lots of acronyms in tax, APR and BPR obviously being quite well used over the last few months. Thought it's just worth recapping on what the allowances are. So all these allowances, which are very familiar in our world, will probably seem a bit sort of odd to those that only look at them occasionally, but a reminder of the inheritance tax allowances that apply to most people in most circumstances. So there remains and always was the nil rate band normal inheritance tax allowance of £325,000. And in the right hand side, some considerations: that allowance is transferable between spouses and has been for quite a few years now. There's another very useful allowance called the residence nil rate band, £175,000 per person. That's worth and basically available if you own your house and leave it to children or grandchildren in most cases. An issue there is you don't get it if your estate is worth too far over £2 million. So there are a few sort of tricks there needed to try and retain that valuable allowance. And then we get on to the APR and BPR allowances. So these are the ones that have changed as of or with effect from April 2026, but announced in the October 2024 budget. So for both of those reliefs, agricultural and business relief, that only the first £1 million of that relief will get 100% relief. It was unlimited before, and now it's only 100% up to the first £1 million per person. It says net debt. That means it's net of debt. So if you've got a block of land or assets on HP, you knock off the debt, and we're only talking about the net figure, but it's still just the first £1 million. Importantly, that allowance is not transferable. So if you have, let's say, a husband and wife situation where everything is in one of the spouse's names and not too much is in the other spouse, there is a great risk that you will not be able to make use of the full £2 million of allowances between you. And then any value over and above that £1 million per person will then only get 50% relief. So the inheritance tax rate is 40%. That will then effectively give a 20% inheritance tax relief on anything over that million. One of the really important things is we're not just talking about property or buildings or things. It is anything that constitutes those businesses. So your machinery, your livestock, all of those assets where we've never really had to think about the value of those before, they all now come into play. Julie, if we can move on to the next slide, please. So what do they cover? So a quick trot through what's covered by each of the allowances. So APR, agricultural property relief, basically covers interest in agricultural land and buildings. So land, farmhouses, qualifying cottages and accommodation. I should say at this point, we're a broad church as a practice. We act for basically any shape or size of farming business, tenants, non-tenants, and very rarely would we sort of necessarily find that anyone was purely a tenant or purely a landlord, as we'd find. So we're dealing with all shapes and sizes really. But agricultural property relief only covers a fairly narrow band of assets actually, and therefore is generally considered the less useful relief. Business property relief basically covers interests in businesses. So typically in the farming world, partnership or sole trade businesses, the capital in those businesses will qualify for business property relief. And obviously limited companies now very common in the world of farming, and the shares subject to qualifying criteria will be covered by business property relief there. But a couple of other points where the tenancies fit in. So tenancy valuations are a complicated world for anyone that's dealt with them, but their interaction with inheritance tax is particularly complicated. It probably lends itself better to specific questions if anyone has them, but a broad rule of thumb, tenancies aren't always given a value for inheritance tax. So a typical sort of generational succession on death of an AHA generally won't have a value attributed to it for inheritance tax. But if there is, for instance, a tenancy held by a limited company and a third-party landlord, then almost certainly that tenancy would have a value when it comes to valuing the company shares. So some complications there, but obviously very applicable to many on the call, given it's a TFA call. Other common themes we're seeing: who owns what? It sounds a ridiculous question, doesn't it? Who owns what? Surely everyone knows you've got a very valuable farm or farming business, all those working assets. But I would say 8 times out of 10, people are not clear about who owns what within the business. They don't necessarily understand how their capital or current account balances work in a partnership, or they can't remember what the shares are, or who owns what block of land, and all of those types of questions, really need answering at the start, particularly in that scenario where, for instance, some of the allowances are not transferable between family members and particularly spouses. So understanding who owns what is a very good starting point. Also, some other quirky points, and this is not particularly a budget point, but business property or personally owned property used in the business. That's really the question of, are you clear whether the property we're talking about, whether it's a tenancy or a block of land or even individual assets, are they property of the business, for instance, the partnership or the sole trade or the company, or are they simply owned by one or more of the individual people involved in the business, family members typically, and then used by the business? Particularly common when we're talking about land and buildings. It's quite often not known. So some pitfalls to fall in there by not being clear on that. Julia, we can move on. So this is a scenario, and to be honest, conscious it's a TFA call, don't worry too much that it's got land and farmhouses and things, because obviously some will or won't have those things. The point is here, it's an estate worth, I think it comes to 7 million in total. And that could be £7 million worth of cows and machinery. The principle is exactly the same, really, on all of that. We're just talking about values, and this gives quite a stark contrast in that situation. So in this situation, it happens to be a landed farm, landowning farm, but they've got a mix of assets from land, houses, machinery, £1 million worth of machinery, no stock in this situation. It's just an arable farm. But the whole lot comes to 7 million. But because it's structured appropriately at the moment, there is full agricultural business property relief available on that full value. However, if we go to the next slide, what we can see is if we then look at the changes from April 2026, you've got the 7 million of assets in total. And it's assumed, incidentally, that some of the other allowances either have already been used or they're absorbed by other sort of assets off the farm, so cash or pensions or things like that. So only the first 2 million of that 7 million would be covered, so that's exempt. And that assumes that asset ownership is sort of sufficiently split between the spouses that own it. The key point being the 50% relief only then applies to the 5 million over and above that that value. So effectively, there is £1 million worth of inheritance tax suddenly payable in this situation for what wouldn't be the world's biggest owner-occupied farm, but obviously very significant value and a significant tax liability. And then if we can move on to the next slide, please. Almost as an aside, but because it will be particularly common, I would say, in tenant farming businesses where perhaps there isn't the dominance of investment in land and property as there might be in landowning businesses. Pensions had been a real safe haven for money, lots of government incentives and tax incentives for people to invest into their pensions, and that have been an extremely tax efficient environment. And what we can probably see is it's got almost too tax efficient. There's been this encouragement for people to put money into their pensions, and then almost a discouragement for people to withdraw money from pensions. So actually the traditional use of a pension has probably sort of been deviated from slightly. So pensions were the other sort of big impact of the budget, affecting, if you like, longer term planning. Obviously other significant changes in the budget would be national insurance changes and things, which I won't dismiss, but the longer term planning points have certainly been the inheritance tax and the pension changes as far as we go. So that change kicks in from April 2027 and essentially brings any unspent portion of a pension pot into the scope of inheritance tax at 40%. Some will have agricultural land, buildings and other business property, and we don't believe there will be any further exemptions for those assets. If they're held in pensions, they'll be taxed as if it was cash or stocks and shares or things like that. Importantly, it's also brought into the individual's estate. So where, for instance, the value of a pension fund might take an individual over that £2 million threshold we talked about earlier for the residence nil rate band, that could have the effect of reducing that allowance as well. You can still use spouse exemption. So if you leave, the first of a couple leaves a pension to a surviving spouse, then there is spouse exemption. So essentially the problem only arises on the second death, which can be useful. Those that have pensions ought to just think about their nominations, essentially the will for your pension fund, if you like, because it falls outside of your normal will, and think, is there any need to consider where those assets go? Should there be a death pre or post April 2027 before the changes come in? I just put at the bottom justifiable changes. I mean, essentially pensions were becoming pots that people were just storing money in and getting almost too much tax relief. While the changes are extremely painful for those with those pots, arguably we are now having very constructive conversations about pensions, particularly with people looking at the different generations. So rather than parents thinking, well, put the money in the pension and just leave it to pass away with it, many more are thinking, yes, we will now actively draw our pension, which hopefully then gives greater degree of financial independence for the next generation coming up through the successors, to then take on the business. So you can make some positives out of what would otherwise seem as sort of quite negative tax changes if you're a bit creative. Julia, we'll move on again, please. So what can you do? I mean, that's essentially what we tried to spend the last 8 months since the budget talking about, because we can talk about all the theory in the world, but generally people want to be pragmatic and say, well, how do we find a solution? So just working through things, understand your position. Do you or don't you have a problem? Because lots of people inevitably have called and said, well, actually, we're really worried about inheritance tax. It's going to ruin our business. And actually, because of the size of their business or the level of debt they've got or the types of assets, or even the presence of, say, tenancies, which might have a devaluing effect, they may have no problem at all. So first of all, understanding whether you have a problem or are likely to have a problem in the future is the starting point. How long do you have to solve it? I mean, this has been in the press a lot, but obviously those in their 30s and 40s would hope they would have a longer period of time to solve it than those in their 80s and 90s. Sadly, I've got clients at all ends of the spectrum. And I can tell you, also the latter end of the spectrum is far more challenging. Some very, very difficult conversations there to deal with. And very difficult to know whether to do something or not, but you have to have constructive conversations to try and work through that. I think where I feel very, very lucky is in the case of most of our clients, we did have some sort of plan in place already. So while this may have sort of completely turned the plan upside down, at least we weren't starting with a completely blank piece of paper. It's been, in a lot of cases, more about how do we, alter the plan that we already sort of had to deal with this. A lot of cases it's meant, rather than having an awareness of what needs doing, it's having to move some things forward more quickly. Common themes. Those that have a plan have a head start inevitably. So as I was saying, if you've done some of the groundwork beforehand, that's a real help. Even getting to the starting point takes time. So we'd have had clients that have called us fairly quickly after the budget say, we want to make a start on it now. The homework time to check who owns what, get solicitors up to date, get the bank in line if they need to have an input, lots of things like that to actually be able to make decisions takes much longer than you might think. There may be a reason there wasn't a plan. That's inevitably some of these conversations about gifting assets and what happens in the future do drag up some very challenging areas of discussion within family farming businesses, and no surprise there, but suddenly people are having to have those conversations with the sort of concern of enormous inheritance tax bills hanging over them, which doesn't necessarily help. Concerted effort and investment needed to manage. Don't pick this up and put it down 10 times and just have a brief look at it. You have to look at it properly, take action, take advice, and come up with a proper plan. Otherwise, it just becomes overwhelming. Succession. I think there's an interesting dynamic, particularly for those looking to pass on businesses, as to whether they are essentially sellers and keepers. You end up having very different thought processes of the next generation are likely to be selling some or all of the business versus those that are genuinely carrying on. And that definitely determines whether you're sort of focusing on the inheritance tax side of things, or perhaps more focused on what some of the other taxes like capital gains tax would be in the event that it sells. And then the last point, is it worth bothering now with all the uncertainty? Lots of clients have said, well, actually, I'm just going to sit on my hands. Again, works much better if you're in your 30s or 40s, but you probably can't afford just to wait, to think about it if you're in your 60s, 70s, 80s plus. I think, what people, people's instincts as to whether they need to take action and need to understand it or want to wait are probably the most important starting point. People that generally are quite relaxed will be more happy to wait than those that are natural worriers. And I think what we don't want our clients to do, or anyone else, is to worry about it and not have enough information to be able to make a proper decision. Julia, do we have one more slide? So common planning options, and obviously we can expand on these a bit more in a minute. So housekeeping, we mustn't dismiss these. Access to allowances, that's the sort of split ownership between, say, spouses or members of the family. How many lots of that £1 million allowance actually do you have access to already between the family members? Gifts, you know, to a certain extent solve everything if you can live 7 years, but they do throw up any number of questions. Life expectancy is an obvious one, but people making gifts will need to think about how they protect the value of those gifts. So do they have partnership shareholders agreements? Do they need pre and post nuptial agreements? Are there wills of the people they're giving things to? Trusts are a whole different question again, but can be extremely valuable. Timing, lots of clients, particularly those at the sort of younger end of the spectrum, are using life cover, and I think that's a great way, often extremely cost effective, of just putting things into a holding pattern. So particularly those with younger children, that they hope there might be succession, are not ready at 15, 18, 20, 25, maybe older, to be given very, very valuable shares in businesses. Life cover can be a great way of just saying, let's buy us some time. Valuations, we're saying some really interesting things with valuations, particularly where, for instance, tenancies are in place, and you often find that the sum of the parts is significantly less than the value of the whole, which is extremely helpful. Company shareholdings in particular are very useful for that. So lots to expand on there. Julia, just risks. So there are risks of essentially doing something and doing nothing. So if you do nothing, there's probably a worry about, should I be doing something? Life expectancy, obviously, will be a concern the older we all get. But equally, doing something, you've got to be absolutely sure that you're going to be in a better position by doing something, or hope you are, loss of assets, loss of control. You could make the capital gains position worse in some cases. Certainly not living 7 years is a risk. And the government could change their mind. I suspect that's wishful thinking, but you never know where we are at the moment. I think whatever happens, whether it's doing something, doing nothing, or going into a holding pattern, it's making a plan, having confidence, and knowing why you've done it, so that if things change in the future, that we remember why we got to that point. And Julia, I think that's the end of my slide, so I'll pass back to Robert. Thank you.
Well, thank you for that, Andrew. And it's a very comprehensive review of where we're up to. And this is what I think people are wanting to understand as they go forward to make their decisions. And I take from what you've said there that you really need to understand your own position, not your neighbours, not your aunts, not your uncles. It's all about you. And I look through there, and that there are common themes about the tax and the succession, but where you come in and other professional people is there are always different tailored solutions. One size won't fit all, and it's whether you're looking at taking Andrew's advice or any other recommended professional within the TFA. Please take that advice, because you cannot make an informed decision unless you know where you're at and where you want to be and how you're going to achieve it. So that I've thoroughly enjoyed listening to that, Andrew. I really have. I've listened to one or two accountants over the last 3 or 4 months, and they've always felt there is an answer there. And it's very important that you don't fester on these things. You go, you talk, you listen, and you try to tailor a solution that benefits you and your family. I would like to think that from what Andrew said tonight, that it will have focused some questions. So I can just remind everybody that's listening tonight to put your questions in the question and answer section at the bottom of the page there, please. And when we come on to Q&A at the end, then we can hopefully have a very interactive event there. I think at this point I'd like to bring George Dunn in, and I'd like George to really cover off what the changes the TFA has been asking for, and the other lobbying things that we have been doing as an organisation. So can I hand over to you, George, please?
Yeah, thanks, Robert. And I certainly endorse what you've just said about what Andrew has had to bring to us this evening. And obviously, if you are on the webinar tonight, now is your time to get a bit of free tax advice on your specific circumstances. So don't hesitate to put your individual questions in the Q&A slot. Now, Robert's just asked me to cover off what the TFA has been doing in response to the Rachel Reeves budget of October last year. And just to say, we were, as an organisation, we were anticipating and expecting the government to be doing something in relation to agricultural property relief. It was an issue that was raised within the ROC review, if you remember, on agricultural tenancies. It had been discussed at many policy meetings. But what we weren't anticipating was that the government was going to make such a fundamental change to business property relief. That came as a bit of a bolt out of the blue, and the way in which they have done it is to think that £1 million is a very big number, when in fact we know in terms of farming capital, it doesn't take very long to get up to that sort of a level. So we have been very active, both individually as an organisation and as far as we possibly can together with other industry organizations in lobbying the Treasury to think about finessing this policy before it comes into effect next April. I've always said, Robert, since the government made this announcement in October, that I cannot imagine the government U-turning on this and just abolishing and abandoning its plans altogether. And clearly there's been a bit of movement on things like the welfare reform issues that have blown a hole in the government's budget, and that will make it even more difficult for us to be making our case to government on this. But the things that we are proposing, we believe, are very, very sensible, measured, and reasonable proposals. So we're not asking for the government to abandon its policy, but what we are asking is that the government finesses that policy. And there are 6 elements to the lobbying that we have been undertaking with government, which members should be aware of. And the first is that we have suggested that the zero rate threshold for the combined agricultural and business property relief should be doubled to £2 million. In the example that Andrew provided for us about the split of assets within a farm, you can see how really quickly you can get up to some serious sums of money in terms of livestock, machinery, crops in store, etc., where £1 million just doesn't touch the size. So we are arguing for a doubling of that threshold to £2 million. The second thing that we're arguing for is that threshold, in the same way as you can do this with your personal zero rate band, at the threshold for APR and BPR, we believe should be transferable between spouses and civil partners, without those spouses and civil partners having to own any of the assets of the business, so that 100% relief applies and can be doubled in a situation of a spouse or a civil partner. The third thing we're asking for is for some flexibility for those individuals who find themselves with assets but who are very elderly, or maybe have a terminal illness where they may not be fortunate enough to remain living for 7 years to do a transfer to the next generation. I mean, bearing in mind that the tax advice before October was to basically die with your boots on and you'd get your APR and your BPR. That changed almost overnight. Obviously, it's not been introduced until April of next year, but it hasn't given a lot of time for people to be able to plan for that. So we're saying that there should be a shorter period over which people are able to transfer assets where they are elderly. We have suggested over 70, or where they are subject to a terminal illness, which will mean that they will die before 7 years, which is the normal rule. And then the fourth thing that we've been proposing, Robert, as you know, is something which we have been proposing for a very, very long period of time, and that is landlords who are letting land to tenant farmers on secure tenancies, and they are those tenancies under the Agricultural Holdings Act 1986, or what we've defined in terms of farm business tenancies, tenancies of 10 years or more, that those landlords should be able to include the value of that land let out on those secure tenancies within their zero rate inheritance tax band. Now, obviously, prior to the budget, we were where this relief was freely available. We were getting a bit of pushback from the representatives of the landlord community on this, and you know, I'm just hoping that now that we are in the situation we find ourselves in, that those same representatives will row behind this idea, because we've talked to many landlords around the country who say, well, you know, we would let for 10, 15, 20 years if we knew we could get that land at zero rate for inheritance tax. And it makes sense from a productivity perspective. It makes sense from an environmental perspective. It makes sense from bringing new entrants in. It makes sense for rural growth. So yeah, that's something we're pursuing. And then a bit of a techie point, and maybe Andrew can comment on this when he comes back in again, because I know you're going to ask him what he thinks about what we're asking for, is the inheritance tax residence nil rate band, which is often talked about by government. And the problem with that is that it begins to disappear once you get over a state's valued at £2 million, and I believe, and Andrew will correct me if I'm wrong, that it almost completely disappears by the time you get to approaching £3 million of value in your estate. So that's something that needs to be corrected to be fit for purpose for the new policy coming forward. And then finally, Robert, what we think is that the government have really created the perfect environment for new money to still take advantage of the inheritance tax system. And what I mean by that is that the government has increased the rate of capital gains tax. The government, as Andrew has said, have taken pension pots out of the inheritance tax zero rate band. And there are people making serious amounts of money in other parts of the economy looking for a place to put that in a tax efficient way. So the continued availability of capital gains tax, business assets, rollover relief is still encouraging people to come into the land sector to buy land, because when they do so, they're getting half rate on the inheritance tax. So if you've got new money in the system, what's not to like? You can hide your capital gain from tax by rolling it over into a purchase of land, and then you're guaranteed half rate inheritance tax on that going forward. It's the old money who haven't got the liquidity to pay the tax where the problem exists. So this idea that the government's going after those individuals who are hiding their wealth from tax is completely wrong. They've created a new market, particularly a new market in parcels of land which are valued up to £1 million, because that gets the 100% relief as well. So what we have said is, why doesn't the government, instead of doing what it's doing in relation to inheritance tax, or alongside some of the other changes we've been suggesting, abolish or significantly curtail the availability of capital gains tax, business assets, rollover relief? Because that's the point at which there is tax in the system, cash in the system to pay tax. And that's the point at which the government could actually rake in a considerable amount of money into its coffers for the public benefit and for the public services it needs to run. So those are the 6 things. I'm sorry I've taken a bit long to do that, but those are the 6 things that we're asking for government to do. At the moment, the Treasury door is firmly shut and saying no changes are forthcoming. But we are in touch with the backbench Labour MPs and others in the hope that we can convince the government to come forward with some finessing as we have proposed. So I know you're going to invite Andrew back to give his critique of our policy before we get into the Q&A. Thanks, Robert.
Yeah, thanks for that, George. And as National Chair, I see the emails flying backwards and forwards between George and the Treasury and what have you. The Chancellor hasn't been prepared to meet us. We keep seeing the same officials. Our numbers are wrong. Their numbers are right. Policy stands. And it's very, very difficult to argue the position when they're not really prepared to listen. Which is such a shame. Before I bring Andrew back in again, we are getting quite a number of questions coming in now on the question and answer box at the bottom of your screen. So if you keep firing into there, that'll be great for when we come into questions. And often the way it is, we don't always get everything answered that night. So Andrew has kindly said that he will answer those questions so that we can put them into a box on the website for members, so you can get the answers to your questions that you've asked. So before we go on to that point, so Andrew, can I ask you to come back in just for your thoughts on where you think we are as an organisation, on the way in which we've asked the questions and what we've asked for, please?
Yeah, I think there's almost unanimous agreement, really. I think and that's not always the case, because George and I've, you know, particularly with our sort of landlord clients, you know, not always the sort of TFA view is exactly the same as ours. I think the only one I would probably slightly tweak, George, is the point about rollover relief. I think, you know, rollover relief, you know, in its normal sense, you know, should facilitate you know, someone rolling over one business asset into another business asset. So I think it'd be very hard for the person that wants to sort of trade up their farm, or, you know, sell one bit of land and buy another, to be penalised by having rollover relief restricted. Where I think the common ground would be, and this has obviously been talked about a certain amount, is, you know, the principle that the inheritance tax take could be dialed down for businesses that have succession, i.e. reduce the inheritance tax take on it transferring across, but with a claw back, most likely of capital gains tax or inheritance tax. It could be structured with either, in the event that that land is, or property is, subsequently sold. And it's not just land or property, it could be selling the herd of cows, or it could be, you know, selling down the family business. I think that's where I would take the money back, again on the basis there's money in the system at that point that could be taxed more freely.
It's interesting you say that one, Andrew, because I think where I see it as a view is where people are making the rollover relief from non-agricultural businesses and rolling it into land. And I've seen that in Cumbria, even in the last fortnight or so, where a non-agricultural business, they're rolling it over, and also when they're also putting money into land for carbon offset as well.
I think the rollover point is the niche one. Lots of people will effectively reinvest money they have made from outside of farming into farmland. You know, 'twas forever thus. But I would say a relatively small proportion would probably benefit from rollover relief, because rollover relief is actually quite niche. You've got to be rolling over a business asset to another business asset. So someone might sell, for instance, shares in a company, but you can't necessarily roll it into agricultural land. They might be reinvesting out of farming money into farming, and I think that's probably the thread. But they're not necessarily doing it with a tax advantage. Obviously, some will be, but you'd have to be rolling over the proceeds of selling your nut and bolt factory into a block of land to probably qualify for rollover relief. Not selling a portfolio of buy-to-let properties to go and buy it.
Okay. Well, thank you for that. Well, that kind of leads us nicely into our question and answer session, and as I alluded to earlier in our webinar, we've got one of our members from Berkshire who's on the combine tonight, so is listening live. So that's how high tech the TFA members are tonight. And the question from the member tonight is, we have a family set up where Dad owns 90% of the farm, cottages and other assets of the business, but is farmed in partnership. We are originally advised by our accountants to place everything we were originally advised by accountants to place everything that did not be in a partnership. We believe that this will mean that we'll no longer be able to access the £1 million annual investment allowance. Is this true? And would we be better off putting the assets into a farming company? And would that help us?
I was lucky to have a very brief lead into this question beforehand, and it's exactly the type of scenario that we're finding a lot. It's inevitable, it's quite complicated, and the answer needs to be a bit more bespoke than this. But I would say that probably the question needs to go back a stage, because lots of the ingredients there, even though Dad owns 90% of the farm and other bits, the fact that there's a farm with cottages and other assets and it's a partnership is in theory a very, very good starting point. Because what I would be saying in that situation is, can the whole lot qualify for both qualify for business property relief, not just agricultural property relief? Because I'd be looking at a situation like that without a great deal of detail, admittedly, and saying, does the whole thing qualify for business property relief, and should we at least be getting 50% relief on it, even under the new rules, not no relief? Because it makes reference to the assets that don't attract inheritance tax relief, but then that those assets might be brought back into the partnership. So I think there's probably a pre-step that I would want to understand, because I wonder if they're actually making the most of the situation as it stands anyway. But moving on from that to the specific questions, yes, we're using trusts quite a lot and putting assets in trusts. And then, if you've got, say, cottages or let properties or whatever that might be going into a trust, to keep them in the business, as it were, the trust might have to become a partner. And in that situation, absolutely right, the £1 million, or it's not £1 million, it's potentially unlimited, so it might be even more valuable, annual investment allowance on buying machinery and plants and things could well be lost. That can be the case if you bring a company in as a partnership or a trust, anyone that isn't a natural individual. Would it be better to put the assets in the farming company? That's probably not a route that I'm taking in many cases. It's quite a nuclear option in terms of, other wider tax effects and probably upfront tax charges as well. Would it protect the annual investment allowance? Strictly yes. And how would the value of the shares in the company be handled for inheritance tax? Well, if everything was in a company and you could cope with some of the other complications of that, because it's not straightforward necessarily, then potentially there's an inheritance tax advantage of doing that. But I doubt very much that's where I would get to if I was planning for one of my clients. But there's quite a lot to expand on some of those points.
Well, I think it's what you said at the start there, the fact that it's tailored solutions here, and that's where I think people have got to take the proper advice. We've also got a nice comment come in here saying that, well done, Andrew, really clear and helpful run through there. So it's nice that people are listening tonight and taking on board what it said. I think, Georgie, if you want to come in on this one here, and then Andrew follow on as well. Does the AHA tendencies have a value for inheritance tax? And now that APR BPR are changed, if that does have a value, why and what circumstances would be the case on paper AHA tendencies carry a value, significant value actually?
So, well, I mean, this is one where Andrew's technical expertise can be brought to bear as well. But as I understand it, as Andrew said earlier on, generally speaking, an agricultural tenancy will not be valued for inheritance tax, particularly if it's an AHA, because the landlord is invariably able to get that land back on a notice to quit on death. And even if there is succession provisions, then the successor tenant gets a brand new tenancy. They don't take on the old tenancy from the previous individual. Now, the rules in Scotland are somewhat different, but happily we're just covering the Wales, so we're not going to go there in terms of the Scottish situation. There could be some issues, and this is where Andrew's input could be really helpful here. In a situation where you are joint tenants, and where the joint tenancy gives you an advantage over what's available in the marketplace. So if you are an AHA tenant on a joint tenancy, as I understand it, Andrew, you correct me if I'm wrong, that the change in inheritance tax thresholds could bring some value to be assessed for the surviving joint tenant or joint tenants, because they will effectively inherit that bit of the tenancy that the deceased has left behind. And equally, that would be true in a farm business tenancy, which was for a long term, which was assignable on death to another member of the family, where that tenancy was being offered at undervalue. I presume that's the same, but generally speaking, there isn't a tax charge per se. But But Andrew, am I right in those joint tenancy points?
Yeah, absolutely right. I mean, I think it's more a case with the AHAs of the likelihood being in most situations that there will not be a value to worry about for inheritance tax, but then building back in the scenarios where there are. So generally where you've joint tenancies is one, and you generally have to sort of value the tenancy on a sort of capitalized rent basis, which is quite complicated. Certainly where you've got tenancies in companies that we see quite a lot, then the value of the tenancy within the company, which is potentially perpetual, has a very significant value as a percentage of the property that it relates to. But that point of, if you like, the classic succession, it being the tenancy for the older generation being a different asset than the tenancy for the younger is the key to it. Really, you are not valuing the same asset between the two generations.
Well, thank you for that. As we say, it's complex, but I think as long as people keep asking the questions, we can hopefully come back to give them some answers. We've got a question here regarding livestock valuations, Andrew, and it says, will those valuations be done under the herd basis or market value?
Market value, really simple. Herd basis is a sort of nice trick essentially around retirement or selling, but it's nothing to do with inheritance tax. But even now for inheritance tax, things would have a full market value. That is going to be absolutely critical, because all those sets of farm accounts where values are perhaps discounted for various reasons and stocks carried at a value, there will be a moment in time when that needs valuing. There are going to be, valuers are going to be extremely busy valuing livestock and dead stock and machinery, depreciation charges that might be over-egged. In principle, HMRC could be saying, no, we want a really robust valuation of all of it, but market value will apply throughout.
And Robert, this is one of the areas that we have been challenging the government about, because with the availability of business property relief at 100%, the tax manual, the HMRC tax manual, says although inheritance tax is paid at market value, because BPR is available, you can use book values and we'll just nod them through. So the figures that the Treasury has done on the basis of who's going to be impacted by these changes have been done on valuations based on historic values rather than market values. And Jeremy Moody from the CAV has done a lot of work on this, and as Andrew says, there's going to need to be a lot of work to revalue these assets. And actually, there's a lot more value about to be taxed than the Treasury is making out to believe.
No, I would agree with that, actually. Yeah. With another question here. If I give an asset away and hope to survive 7 years, but die before the 7 years are up, is the taper for IHT related to the 40 or the 20%, Andrew?
Well, taper relief, lots of people know about taper relief, and it sounds very simple because you live 3 years and then essentially it tapers off to 7 years, but it never works quite like everyone thinks it works. It's not quite a straight line. But setting that point aside for a minute, the question, well, the answer to the question depends on whether the gift was made before or after the budget. So if the gift was made before the budget, then essentially it is tapering down the value from 40%, or under the old regime, it's tapering it down to zero. In the post-budget world, essentially it will be subject to the 20% tax, the 20% tax regime, and the taper will apply on the 20% rate, but it won't taper. It won't be effectively zero like it would have been on a gift before the budget. So gifts before the budget, just to be absolutely clear, are much better than gifts after the budget, where there is that tail, but it should only be at the 20% rate after the budget.
Right, okay, I think we've got to be a bit on there. We have a question from Michael here. Does corporate ownership of land offer any specific advantages or disadvantages with respect to IHT, or is it irrelevant in that probate will the value of the company be realised, the value of the land?
So we are finding it very helpful at the moment where we have, if you like, split businesses. So businesses with tenancies, businesses where you have companies owning things for historic reasons are often very helpful because they can have a devaluing effect. But that is quite different than saying, is there a planning opportunity here? So the question of, well, should I put everything into a company then, is a slightly different one, because you can end up with very big transaction charges. So it might be capital gains or stamp duty or things by moving assets around either between individuals or particularly into companies. So the simple answer is yes, it could have an advantage, typically because if you have multiple people owning shares in a limited company, and where they're not spouses or civil partners, for instance, you typically have a devaluing effect compared to the pro rata basis, because individuals typically have a less than 100% or a minority shareholding. So that's helpful. But whether if you have a farm or even a business holding, tenant farming business holding working assets, and go and put it all into a company, whether that helps and whether the combination of taxes gives an overall saving is a slightly different question.
Well, thank you for that. We have a question from Ruth here, and this one's in 3 parts. So we like 3-parters on here. And this relates to capital gains question. Are there any capital gains tax implications of transferring capital accounts in partnerships between partners? And I'll let you go with that, and then we'll just do them one at a time, please. Andrew?
Yes, it depends what's in the capital account. So typically we might see what we call general capital in partnerships, and then we might see real property or land capital. Essentially, if you're transferring the real property capital account around, it depends what it's used for. So basically trading assets, so land, agricultural buildings, tend to be a lot easier to move around with no capital gains tax charges arising. If that land capital constitutes, say, a let property or a let industrial unit or something like that on the farm, then there probably would be a tax charge arising if it isn't managed. This principle of using capital gains holdover relief is very valuable. That basically allows you to move trading assets around a lot of the time with no immediate tax charge arising.
Okay, well, thank you for that. And the second part, is the position different if the capital account is made up of wasting assets like plant and machinery rather than land and property?
I wish I'd read the question 2 before I answered question 1 now. Slightly repeat myself. Yes, it is. It's a simple answer, because if it's land and property, you have to decide whether it's trading or investment, rental assets. Yes, it is. And again, it should be far more straightforward, less likely to have a tax charge if it's plant and machinery assets used in the trade because of their trading nature.
Right, okay. And then leading to part 3 here, we will see capital accounts being treated differently by accountants as a result, i.e. introduction of wasted assets, capital accounts.
Well, I think this sort of goes back to George's point earlier.
Yeah.
I mean, the accounts are going to give a framework, but the revaluation of everything to market value will wipe the slate clean. So it might tell you how many, rusting tractors or, prime, dairy cows that you've got at the date of death, but the valuation of what the cow or the rusting tractor is worth will be the thing that drives it. So, I mean, yeah, there might be, I think what we'll probably see is a greater degree of focus on those sort of bits that can often get ignored in sets of accounts, so the capital accounts and things, to understand ownership, to understand what's in there. Is it up to date? You wouldn't want to be carrying, for instance, loads of value in the partnership accounts that have been written off years ago, so a bit of housekeeping is probably needed. But again, the market value will ultimately give the answer.
Well, thanks again for that. A question for George here. Are there any further noises from government about when the ICT consultation details of rules of individuals might come, possibly July, August?
So we are not expecting any further consultations from the government on these changes. So we did have a very complicated consultation on the impact of the changes on trusts earlier in the year, which I'm sure Andrew has been all over like a like the serious accountant that he is. But we're not expecting any further consultation. What we are expecting to see is the tax information note at some point, together with the draft legislation for the finance bill, which will have to go through both houses of Parliament. There was anticipation that we might see that before recess. It's looking increasingly unlikely that's going to happen. So we are going to be pushing back into the autumn for that, and obviously we will be going into action in relation to those bits of legislation to lobby MPs and peers to bring forward necessary changes. But we would also hope that the government might consider some changes before they introduce that legislation to Parliament. So yeah, no further consultations planned as far as I am aware, Robert.
Okay, well, thank you for that. And I suppose
I think Andrew has a comment.
Yeah, please do.
Well, only this point about timing is a serious problem, because there've been such stability within these reliefs for 30 odd years that it completely put the cat amongst the pigeons in October 2024, and now people have a real fear of budgets, because that's the next time that the cat can be put amongst the pigeons again. So we October, people weren't really expecting it, and then it happened. And of course, a lot of things happen with immediate effect from October 2024. Okay, the changes to inheritance tax or changes to APR and BPR don't come in until April 2026, but gifts immediately from the budget fall under the new rules, not the old rules, unless you die before April 2026. So we certainly had a lot of concern coming up to the spring statement. Would there be further changes? And what that means is people panic and try and make changes, or don't and worry that they haven't made changes. And now we're looking at the next budget 12 months on, and essentially people will be trying to think, should I be doing something before the autumn budget? We don't know when that will be, September, October probably. And we haven't even got the detail firmed up from the last one, including whether they might completely U-turn on it. And it is causing so much sort of concern and uncertainty. And to be honest, panicky thinking, not helpful.
Well, that kind of leads nicely, Andrew, into a question here. Crystal ball, Andrew. What is Rachel from Accounts going to do this October's budget?
It's an awful question. I don't know. Maybe
no pressure here.
Maybe set out the detail from last October's budget. I think the farming vote, not making a political statement, but the farming vote will be pretty damaged. So I don't think there's anything necessarily to stop her keeping going. I don't think there's going to be U-turns. I don't think there's the money in the government coffers to make U-turns on any of this or big concessions. I don't ascribe to the fact they're going to get rid of what they talked about, but I wouldn't rule out it couldn't get worse. And the ways of waking. And I'm not saying I think this is going to happen necessarily, but there are ways it could get worse. Particularly limiting the ability to make gifts and things would be extremely damaging, because that would hamper planning. But I think it's more likely that, assuming they stick to the election pledges broadly of avoiding the big, headline income tax and essentially taxes on workers, they probably have to go at something like capital gains tax to a certain extent. That there aren't many levers left to pull. That's probably one they could go at, and that's a concern.
Yeah, I was quite disheartened listening on the radio this week how one MP came out and said that how Rachel was going after unearned wealth. Well, I kind of feel that it's all been earned by the people that get up at 3 a.m, go to bed at midnight, and then do it all again the next day. I think it's very naive the way in which some people are kind of coming into this whole debate when they are totally they are not even up to speed with what is the truth, and it just blows my mind sometimes. My granddad used to say that it's better to be thought a fool than to open your mouth and remove all doubt. And I think we've got a lot of people coming into that at the moment, I'm afraid. who really haven't a clue what they're talking about. I think in closing for this evening, and we always find that we have too many questions we have answers for, and Andrew's more than happy to put them onto the website once we are finished tonight, and we'll get them out as soon as we can once the whole video has been edited through. So on behalf of the TFA, I would like to thank our speakers this evening, Andrew Vickery and George Dunn, as well as our sponsors for this evening, Roythorne Solicitors. We are taking a break over the summer months so that our members can concentrate on harvest. Our virtual event will continue in September, so don't forget to check for updates published on our events calendar on the TFA website. I hope that you found this evening's discussion insightful. I know that I have. And thank you for joining us, and we look forward to seeing you next time round. Good night.